Good day traders, Chris Weston here. Once again, looking at the week ahead. We're looking at implied volatility and across all asset classes. We're looking at the expected moves, what the catalysts are going to be to drive us there. And really trying to understand the sort of dynamics that we need to understand, not just to manage risk better, but also to understand how to achieve correct position sizing in these markets as well. I'm going to show you a number of really clear charts to me which give real clear context about the level of hedging, the cost of hedging, those positions as well, and you know, hopefully should give some good insights. So if you do find yourself liking the video, do click on the like button. You know, I'll clearly appreciate that in this. Let's focus on what's happening in FX markets to set the scene straight away, because implied vols is really causing that bid in safe haven assets. There has been some big gyrations in markets throughout the week. You're going to get that when you get implied vols so high. So it's not really dictating the scene in its entirety, but you can see over that when we sort of aggregate everything together and see the wash up over the last 5 days, it's been the Swissy which has really stuck its hand up and said, I'm your safe haven of choice. I am that #1 safe haven at the moment. I still quite like the Japanese yen, but we are coming into a situation where the Bank of Japan will be meeting in the next couple of weeks, and the market is expecting them to cut that deposit rate even more. That's going to have a really negative impact on the Japanese banking space. We'll talk about the ECB in a moment, but also they're going to have to offset that somehow. So the Bank of Japan are in this kind of rock and a hard place, such as the ECB, where the market's expecting them to cut rates. They probably will have to cut rates to stay involved with this sort of synchronized, coordinated easing cycle that we've been seeing. But at the same time, they need to do something to offset the weakness and the implications that's going to have for the banking space. So the Swissy, probably just your #1 safe haven. That's what the market's been saying here. The euro has had a good week. Obviously, with implied vol, it's not really anything too much fundamental. It's really the idea that the ECB may be cutting rates, but I think this is more the idea that you've seen high implied volatility. So people have been unwinding or buying back those carry positions. People obviously sold euros because you use that as your sort of preeminent funder to take part in the carry trade. You've been buying South African rand, you've been buying Mexican pesos, your Indian rupees, Indonesian rupees, those kind of currencies, and that's unwound. So really that's propelled euro dollar nicely up into this sort of 112. 20, 112, 30, 40 sort of zone you can see on the daily chart there. A break of that technically looks really good, but I am quite concerned about what's happening in euro dollar and specifically in the euro situation. If the ECB are going to cut rates by 10 basis points, which I think is nearly discounted into the markets, they're going to have to do something again to offset that, because the European banking sector, have a look at the daily chart of the EU banking, of the stocks, finance or banking sector. It looks disgusting at the moment, and you know, you've got the idea that this could be coming down to sort of the 2012 Mario Draghi do whatever it takes type moment, those lows. If that breaks or goes even to test that, that's going to get a lot of implications. People are going to be talking about it on social media. The media is going to be making a big song and dance about the European banking space. And what will the ECB do in that situation? So they're going to cut rates, but that's going to make banks pay even more money to hold capital on the ECB's balance sheet. That can't be good for the euro. We're also watching what's happening in Italy, because there's 3 countries where the coronavirus is really centred at the moment in terms of that R0, and that is Italy, that's Iran, and that's Korea. And, you know, you are watching those Italian BTP spreads against German bunds. I think that's going to become much more prevalent as a driver of the euro going forward. It's going to be much more of a driver towards what's going to happen in European stocks as well. And if that Italian spread starts to widen as people see sort of increased risks, and that probably will transcend into political risks, you know, that will resonate in the euro at the moment. So, you know, it's difficult for me to want to chase euros at this level. We've seen a lot of buying in euro against the Australian dollar. That's where we've seen quite a large of exposure. But it's difficult to chase the euro when you've got Italy very much at the heart of the concerns there. They're shutting schools, they're limiting people going to work. It's going to have a big impact on economics. That's only going to play into political anxiety. You're going to see that in that BTP spread. On the downside, you can see that it's those high yielding currencies. Those currencies that have done very well as part of the carry trade. You want to be long the carry trade and long high yielding currencies when vols are low and equity markets are trending higher, credit spreads are low, and you're not seeing that at the moment. So you can see when you're talking about FX markets, what's working is this vol. Vol is dictating everything that you're seeing there as well. Now have a look at what's priced in. We've obviously seen the Fed going above and beyond. They had the emergency meeting, 50 basis points were cut off the Fed funds rate. The market was expecting rate cuts, but they came out, first emergency meeting since 2008. It spooked the markets. They said, well, if the Fed are worried, perhaps we should as well. But rate cuts are not going to work in this situation. Yeah, they're designed to appease deteriorating financial conditions and try and produce some liquidity into markets. And also, you know, rate cuts around the world are going to improve the net present value of equities, and that's good. And we'll talk about the equity risk premium model going forward. But you know, you've got to think about this and what's going on in the scenes in 2 or 3 months' time. You know, look, economics are deteriorating. There's no doubt about that. People's lives are getting affected. This is about to ramp up in the US. They're doing more testing in the US, and that's good. But it's also going to mean that numbers are going to increase as well. People who have coronavirus are going to increase, and that's going to be something that's prevalent into a lot of countries as well. It's going to make its way into Europe in a much more greater scale. But at some stage, further down the line, it will go. There's no doubt about it. It's a virus. You know, economics are going to deteriorate in the short term, but longer term, the virus will be contained and it will go. The question is what does the global economy look like after that? But what's interesting for me, and I've been talking to clients about what is once this all goes, we are going to be left with a situation where central banks will have no interest rates left to play around with. We're going to have QE probably in Australia, and we're probably going to have it in the US. And I think if you look at the long end of the curve in the US, you look at 30-year treasuries at 1.56%, are probably already discounting an element that the Fed are going to have to go down QE. Certainly if you have a look at the gold price at the moment, you know, it looks really bullish. I expect that to sort of trade higher in the short term. The fact that we've got 10-year real rates at negative 48 basis points, we've got 5-year real treasuries at negative 63 basis points. I think the market is saying, you know, we're not just going to see the Fed cutting to zero, but you know, we're probably likely to see an element of QE being placed in there. So we've got to understand what the stock markets look like, the equity markets look like longer term without that support of interest rates. We're going to be pretty much down at zero across all countries. There's going to be negative rates in some countries, and we're pretty much going to be at QE as well. Where's that support going to come from for equity markets, from central banks, if we don't have interest rates to mess around with? And actually have a look at this chart here. You can see the level of interest rate cuts that are being priced in across the front end. You know, you go to the next Fed meeting, which is or the actual scheduled meeting, which is the 18th of March. The market's looking for over 2 rate cuts in that meeting alone. You go down, we've got looking for 81 basis points of cuts over 12 months. The next RBA meeting on the 7th of April, we're looking for, you know, another rate cut to come through. That takes us down to 25 basis points. That's the effective lower bounds for the Reserve Bank of Australia. We are going to be talking about quantitative easing. What does quantitative easing look like in Australia? Well, it pretty much it's clear to me that they're going to be buying government bonds in that sort of 3 to 5 year maturity bracket. That should have, in theory, an idea of steepening the yield curve in the in Australia, and it should bring down the Australian dollar on a trade-weighted basis. And that move in the Aussie dollar will take place before they formally announce that. Have a look down there. You know, you've got the Bank of England fully expected to cut rates on the 26th of March. The Bank of Canada, you know, they cut rates by 50, but they're expected to cut again on the 15th of April. The Reserve Bank of New Zealand meet on the 25th of March. There's one rate cut of 25 basis points fully priced in, but a 64% chance that they come again and do more there as well. So the market is expecting central banks to come. Again, I reiterate that view that you know, what does the world look like when central banks have nothing to play with? Unconventional policy, and the art of QE is now like fully conventional. Where does the support come? How do we suppress volatility going forward? And actually, if we set the scene looking at volatility, you know, you can see the VIX on this top pane, the implied volatility in the S&P over the coming 30 days. And we're sitting on the long-term average here. I've included the GFC move that we saw when we got up to sort of nearly 80% or so. You can see the blue line going through the middle of that. That's the long-term average there. We're actually sitting over 2 standard deviations now above that, and that has been a level where generally you've been quite good sellers of vol, but I wouldn't be selling vol at the moment. And you can see the move that we've been seeing on the bottom pane in bonds, where we've used the Bank of America Merrill Lynch move index, and this looks at implied volatility on a weighted basis between 2, 5s and 10s treasuries, and you can see that's really spiked up as well. So obviously there's been a big bid coming through in the treasury market. That's seen implied volatility move up. Actually, FX volatility is relatively subdued. You can see the global FX index from JP Morgan at 7%. We'll talk about vols in a minute, but that has it's probably where the vols are cheap on a relative basis to other asset classes. But as long as that VIX is high, you know, you are going to see the carry trade being unwound. And actually, I think if you're looking at vols and look at the way that the equity market is playing into pricing, I think this is a really interesting chart for me. Have a look at the S&P, and we've seen a lot of flow coming through in our some global indices at the moment. But look at the influence that the index is having on market pricing around rates. So you can see here the number of rate cuts that are being priced into the Fed funds future, and specifically I've looked at what's being priced in for June and relative to the S&P, which is the blue line here. So the S&P has fallen. You can see that the markets of the algos have really just followed this, and you can see that the number of rate cuts that are being priced in, which you can see on that right-hand axis, have increased dramatically. And then we've seen a couple of bounces as well. And rates have moved up a little bit there. So what are we looking at here? Well, if the S&P really continues to fall, and we do break below this double bottom that you can see on the daily chart, that number there, 28.55, that is the absolute key level now. Now, if we continue falling and we break below 28.55, how much more rates can actually come into the market? We're pretty much rich there. I've been saying that for a while. I've been probably underestimating the extent there, but you can see that the number of rate cuts that are being priced into the interest rate markets are really following the S&P. So I think you really do need to keep a view on what's happening in the S&P. The number of rate cuts that are being priced in is obviously having an impact on dollar yen. You've seen dollar yen testing that 106 level. So if the S&P falls, the number of rate cuts being priced in is going to hit, and that's probably going to impact the US dollar as well. So we are watching the S&P. Have a look at the one-day percentage moves in the S&P. Staggering stuff. You've seen these yellow boxes which I've drawn. And you can see just the one-day percentage moves up or down through that equilibrium line, that zero. And you can see, go back to 2018, we had that compression in the number of days where we saw big moves. And it was kind of like this cold spring that just unleashed as we went into the back end of 2018. You can see those bigger moves up and down. And that's similar to what sort of played out through October to January. You can see those moves, those one-day percentage moves were really, really contained within that. And it's just, as we've seen now, bang, up it goes. We've seen some huge moves, very reminiscent of the GFC, where we saw massive moves down and we saw these sort of short covering moves up as well, where markets were oversold and underloved. Have a look at this chart. I think this is absolutely fascinating chart. It tells me a lot about semantics. You can see in the top pane what we're looking at is the difference between S&P 25 delta 1 month call implied volatility, and we're subtracting that against put volatility, 1 month 25 delta put volatility. And what we can see is that's trading at -16 at the moment. So that is telling me that put volatility is trading at a 16 vol premium to call volatility. That's the biggest move since I think 2008 there. So you can see that put volatility, the cost to buy effectively, or the anticipation of downside moves relative to upside moves, is trading at the most extreme since 2008, since the GFC. That tells you a lot about semantics. The put-call ratio to the downside, another one that I put into my equity model to understand pessimism and euphoria, not so bad at the moment. I think if we're looking for a really extreme move, we'd probably be trading at 1.4 puts to calls. That's not happening at the moment. You can see that's at 0.88. But the implied volatility in the market is really, put volatility is substantially higher than that of call volatility. Staying in the vol space is another one that goes into my sort of equity timing model. And you can see that the VIX as a ratio of 3-month VIX. So the VIX looks at the implied volatility in the S&P over the coming 30 days. We're looking at as a ratio relative to the CBOE's 3-month implied volatility index, the VIX there. And you can see again that's at very, very high levels. We're trading at 1.22. So that's telling me that ratio has really moved up to extreme levels. We've gone for we've looked at this move over since 2002. The blue line again looks at the mean of that move. So we're trading over 3 standard deviations of that move there. So again, how much pessimism being priced in? People have been massive buyers of short-term vol relative to longer-term vol, and that's actually been something that's been quite a good timing mechanism to understand the level of fear and panic that's in these markets. Have a look at the S&P. What we call the equity risk premium model. So we're looking at equities and the earnings yield, the current earnings yield, and we're minusing there the 10-year treasury yield. And you can see that's trading at 5.5. So the equity risk premium in the S&P is very, very high. And that's actually been quite a good reversal model as well. This has been a good timing model of how much pessimism is being priced into the stock market. Really, every time we've gone above 5.2%, so the amount of basis points that the earnings yield in the S&P is over the 10-year has been some really good indications of how much is being priced into. That equity risk premium now is really high, trading at the highest level since 2014. So that tells me that there is some valuation support kicking into the S&P. Does that mean we're going to get a timing? Obviously, you've got to look at price and whether we're going to start seeing buying coming back into stocks. But if I have a look at the level of pessimism that's being priced into these markets, the level of pessimism being priced into market internals, the equity risk premium, volatility measures, I would say that we haven't seen anything like this for a long period of time, and rightly so. Buying stocks now seems like a low probability trade, but I will say when you're looking at the amount of pessimism being priced into stocks, it hasn't been this high for a long period of time. Have a look at the volatility measure of FX markets. You can see the Aussie yen implied vols for 1 week sitting at 14.1%, 73rd percentile. It still seems quite low, to be honest, when you're looking at what we saw in the equity market there. There's not really much to drive the Australian market this week. We're not seeing any changes. Again, it's just about coronavirus. Aussie yen's probably going to take its correct direction from the equity market. If the equity market breaks down through 28.55 on the S&P, Aussie stocks fall, Aussie yen will probably go down for the ride as well. That said, I mean, you have got some good support into that sort of 70 figure. If that breaks there on Aussie yen, you'd be sort of joining that and trading that from the short side. But having a look at Aussie yen now, implied vol, realised vol was really ramped up. You can see that the 5-day ATR sitting 136. That's really, really high compared to where we were last week. Pull up a daily chart of the ATR of Aussie yen on your own MetaTrader platform. You can see that the average true range has really spiked up. But that's trading with a 1 week implied vol of 14.1. Gives you a 125-point move. If you price that by the straddle price, it gives you a range as we go through the new week of 71.43, 68.93. Dollar yen's been a staggering one. That's pushed right to the top of the pile. It was a really boring currency pair for such a long period of time. We're now trading at that 1 month range in terms of the implied volatility at the 90th percentile. So the market's expecting a range next week of 107.52. We could even go down to 104.76, and that's only got a 68.2% level of pricing and confidence. I could go out and do a 10 delta strangle and look at something that's a bigger move and a bigger outlier, but the market's saying on the downside we're probably likely to get down to, or price should be contained around 104.76. Still pretty low, 9.23% with 55 percentile. The market's expecting a move up or down in Aussie dollar, 90 points. As I say, not a lot to drive. Got NAB Business Conference, Westpac Consumer Confidence numbers coming through. Dollar CAD, no, not really looking for huge amounts of drivers there as well. In the dollar side, there's not really a huge amount of data or event risk to really look at. We've got the CPI numbers coming out. Markets expecting small tweaks to that. But again, it's about what the US economy looks like further down the line. If we do see the consumer starting to get hit, people's behaviour starting to change. So again, you can see the implied moves on this table going forward as well. The VIX, as we say, at 40%. That's the 100 percentile. So you can use that quite nicely. In dollar yen, in terms of risk reversals, I've been really looking at the difference again in FX markets between call volatility on 1 week relative to put implied volatility. Have a look at dollar yen, because as we say, we pushed really to the high of the pack in terms of what's happening in dollar yen, and people are seeing explosive moves up or down in dollar yen. But have a look at the skew, the difference between calls and put volatility, and you can see that sits at negative 0.277. So put volatility trading at a premium of call volatility by quite a substantial margin now, trading at the sort of lowest levels on this risk reversal index since 2017. So the options market is really speculating that if we're going to see an explosive move, it's going to be the downside rather than the upside, and we're expecting big moves there as well. So again, that plays into semantics in terms of what people are expecting. We look to sell rallies in dollar yen in this environment, given that the Fed are really behind this now, trying to weaken the dollar effectively down to those downside. And again, just to sort of cap up with what we've been seeing in equity markets, and this one really hits home, is what's happening in credit markets. When we see deteriorating economics, which of course this is what it is. This is not the GFC, what we're seeing now. This is not a liquidity crisis, not a banking crisis. Well, maybe in Europe to an extent, but across the world, we know that the banks are in fairly healthy condition. They're in rude health. Their balance sheets are much better. This is an economic crisis in the making. And that's why we look at credit spreads above everything else in this environment, especially what we're seeing in high yield. High yield credit spreads are widening relative to investment grade, and that's going to be a concern. In investment grade, we're looking at triple B because the amount of debt in that pool held by companies that are rated triple B is staggering, trillions and trillions of dollars. And of course, if economic fragility kicks in, those spreads are going to widen. It's going to make those companies very, very difficult to refinance. But it's also meaning the ratings agencies, S&P, Moody's, Fitch, are probably likely to downgrade them. At what level does that happen? I'm not a credit expert by any means, but we know that equity markets will be following this more closely. If economics are going to get hit, we will be watching credit spreads much more widely. Now have a look at this chart here. You can see the difference between high yield spreads and investment grade spreads. The white one, the index there, has been moving up quite sharply. We're at the highest levels really now since 2019, the early 2019 levels. Really when we got that big move up and the Fed did the big pivot. We're not at systemic levels by any means at all. I'm not genuinely worried at this stage, but we do have this on our radar because it's moving up. That rate of change is accelerating. And what we've got here is the map against the S&P, which I've inverted. So you can see that the S&P is going up. In theory, actually, it's going down, but there's a correlation of sorts between the two. If I see that high yield credit spreads widen substantially against investment grade, that to me is going to be the driver of the S&P through 28.55. On the other side, if people start seeing better signs of economics, that they see that the coronavirus the intensity is starting to dissipate, you will see those high yield spreads start to narrow relative investment grade, and I think you're going to see implied volatility across all asset classes come in a little bit there. So this is one of the key charts that I've got on my radar going forward. The idea that high yield spreads, a really risky part of the market where you're likely to default more likely than any other part of the market. You know, if you're seeing that those spreads widen, you are going to see risk aversion playing through in the FX markets, commodity markets, and also in the equity market as well. So we're watching that very, very closely. So we continue to watch what's happening in rates, how much of that is now discounted. We continue to watch what's happening in coronavirus, the spread that's coming through, the actions that are going to be taking place by governments to try and contain this. Of course, the more radical the actions, the bigger impact that's going to have on economics. We are worried about economics, and that's why we've got our eyes on these credit markets as well. So a lot to focus on. It's not so much about the data, because the data is largely irrelevant at this point. It's about what the data looks like in the future and how do we go around modelling that. And again, the coronavirus continues to be the dominant thematic. So do reach out if you've got any questions around volatility, about how we can help you at Pepperstone around volatility and trading around there. I wish you all the best of luck in these markets at the moment.